Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. Second week of February. Everyone here is off to a great start. This morning I talk about financial markets. Lots to talk about. A real strong week in the stock market last week. A little weakness in the bond market as some of that flight to safety money that took place the previous week got unwound. I'm going to talk this morning and go over some statistics, talk about Barrons, turn things over to Brad, speak briefly about the bond market. So a lot to go over this morning. Again, key focus in all that we discuss is to focus on what we can do to best think about the proper allocation to financial markets, given whatever our personal goals and personal risk tolerance happens to be. This applies to all investors and all advisors who are working with investors to focus on the plan, focus on the goals, and to constantly work to reiteratively improve based on information that we get from, number one, performance, and number two, how we as advisors and investors feel during those particular gyrations in the market, and to be able to adapt and structure portfolios appropriately. So, get started this morning. A couple of statistics start this morning with some numbers, hopefully to provide us with some perspective and some thought-provoking information this morning. So, taking a look at stock market ownership, 84% of all stocks are owned by 10% of all American households. Birth rate. China had 14.6 million births last year. That is its smallest number since 1961. The U.S. had 3.8 million births, the smallest number since 1986. So China with still almost 4 times more births there than here in the U.S. Population, over 65 in the world is now 9.3% of the world's population is 65 or older. That number is 12% in China and 16.6% here in the United States. Over the past 25 years, so going back to 1995, the Consumer Price Index has increased by 71.7% or 2.2% annually. So if you're an investor who is living on a fixed income or who has monetized their portfolio because and gone to fixed income because they are retiring, keep in mind that if you had set up a fixed number in 1995, that number would have been reduced by about 58% based on purchasing power over those last 25 years. So if you had not built a portfolio set up for inflation, your buying power would be significantly curtailed, almost 60% less buying power. City of Topeka, Kansas, for those of you who are looking for perhaps a new place to move, beginning January 1 of this year, has set up some incentives. If you come to live and work in Topeka and you stay there a year, you're eligible for a $10,000 award. If you were to rent a home in 2021, you'd be eligible for that award, or $15,000 award if you were to buy a home. Over the last 50 years, the S&P has gained an average of 10.6% a year. The index has been up 15 of the last 17 years, and it's been up 40 of the last 50 years, or 80% of the time. Compare that to bonds. If you're looking at the Barclays aggregate bond index, its total return last year was 8.7%, best return since 2002. In the last 44 years, there's only been 3 negative years, so about 7% of the time in the last 44 years have you had a negative return if you were invested in bonds that made up the Barclays aggregate. Taking a look at the national debt. The national debt increased 86% during George W. Bush's 8 years as president, reached $10.5 trillion in 2009. During President Obama's 8 years as president, it went up almost as much percentage-wise, 88%, and we had a deficit that approached $20 trillion. The deficit at the end of 2019 was $23 trillion, so the deficit has gone up about 16% over the past 3 years since President Trump took office. The number of existing single-family homes for sales, which has been tracked for about 40 years, and that number peaked at 3.4 million homes for sale, and that was in 2007. And in December of last year, so last month or a month and a half ago, that number fell to an all-time low of new homes for sale, 1.22 million. And for those golf fans, 49-year-old Phil Mickelson was ranked as one of the top 50 golfers in the world for 1,353 consecutive weeks. And that is for 26 years he was ranked in the top 50. That came to an end in November of last year. 26 straight years being considered one of the best golfers in the world. Moving on to financial markets. Last week, despite the sell-off at the end of the week on Friday, markets posting impressive equity returns. S&P up over 3%, Dow up 3%, NASDAQ 4%. Emerging markets were up just under 3%. Foreign stocks up just under 2% last week. We did see some mild weakness in bonds, which I alluded to earlier. The 10-year Treasury was down about 0.6%. Municipal bonds outperforming and down just 11 basis points, even though we saw that strength. So that weakness in treasuries, municipals proving resilient, and something Brad's talked about many times before. Talking about financial markets and where we are this morning, S&P futures trading a couple of points below fair value, actually now approaching fair value. And markets last week were encouraged by the U.S. economic data as well as liquidity injections into the Chinese markets. The number of confirmed coronavirus cases in China approached 30,000, death count nearing 1,000, and the head of the World Health Organization says that we may be only seeing the tip of the iceberg, but U.S. markets so far are unperturbed and trading near all-time highs. Right now there is a sense of faith that the U.S. will be all right thanks to a tight labor market continuing to foster healthy consumer spending, low interest rates continuing to favor equities, and central banks continuing to implement dovish monetary policy. To that end, Fed Chair Powell will head to Capitol Hill on Tuesday for his 2-day semi-annual testimony before Congress. Later in the week, we get key reports in the Consumer Price Index for January, and retail sales for January will be released on Friday. U.S. Treasuries trading little change, 2 years around a 139, 10-year down 1 basis point, about a 157, dollar relatively flat, and crude oil is down just slightly at $50.27 a barrel. Tesla, which we're going to talk about when we get to Barrons, lots of articles talking about Tesla and what the gyrations in that stock may mean. Tesla this morning, last I looked, was up about 55 points, about 7.5%. And that is on a story in Forbes, which makes the case for why Google should purchase Tesla for $1,500 per share. So there was an article in Forbes speculating that is something that would make sense. Not that that's been proposed, but commentary from the magazine. Equity indices in the Asia-Pacific region began the week on a mixed note. Japan was down 0.5%, so was Hong Kong. China was up 0.5%, India down 0.5%, Korea down 0.5%, and Australia down 0.2%. If you were sleeping and missed it last night, Parasite, which is a South Korean film, was the Academy Awards choice as the best picture of the year. Yesterday, President Trump unveiled his $4.8 trillion budget, which was the opening position in the beginning of the negotiations with Congress. There were proposals in there largely to raise some spending on some military, specifically to raise spending on NASA and space exploration and space for military purposes, and there was some cuts to social safety net programs, especially Medicare and Medicaid, as well as some big provisions to reduce foreign aid that the U.S. doles out. Amazon just announcing that they've pulled out of the Mobile World Congress, which is a gathering in Barcelona of 100,000, discussing mobile technology and citing the coronavirus outbreak. And this is something that we need to watch because more and more companies start pulling out of travel and conferences. That's something that could have an impact on the economy over time. Looking at what else we have going on this week, mentioned a couple of economic reports that are going to be closely watched. We do get some earnings reports as well as they start to become less numerous, but nevertheless some significant earnings reports to watch. Tomorrow we get Dominion Energy and Under Armour, which has been under a lot of scrutiny. Under Armour with some of their accounting practices. Then on Wednesday, Applied Materials comes out with earnings. Barrick Gold, Cisco Systems, CBS Health coming out on Wednesday. I mentioned Thursday we get Consumer Price Index for January. Expectations are for a 2.5% year-over-year gain, up from 2.3% in December. Factoring out the volatile food and energy prices, the core CPI is seen rising 2.2%, and then on Friday we get the University of Michigan consumer sentiment, and then we get the retail sales, which are expected to show a 0.3% gain, factoring out autos and gas, 4% gain there for retail sales. So moving on to Barrons. Barrons talked a bunch about Tesla. I think there were 4 separate articles that mentioned Tesla and what the significant gyrations in Tesla may mean for the financial markets. Barrons certainly concerned about what they call the mania around Tesla and what it may mean. One article entitled, "Tesla's Manic Rally Isn't the Only Sign of a Market Bubble." When the gyrations in the financial markets attract the attention of those normally not concerned with such matters, market lore says it's time for those who are involved in the financial markets on a consistent basis to start becoming concerned. Of course, there's the famous story about JFK's dad, Joseph Kennedy, hearing stock tips from the shoeshine boy. And Randall Forsythe, who writes a column every week for Barrons, one of their leading commentators, expressed concern that when his son, who's at college, started texting his dad, who's a well-known author in the financial literature world, and starts texting his dad saying, "Hey, what's going on with Tesla?" And he starts forwarding his dad a chart on Instagram. He said that alarm bells started going off for him. He points out that he's tried in the past to get his son interested in financial markets, buying him up a portfolio of things he had expressed interest in, like Nike and Under Armour and Sony for the PlayStation and things like that, and never any interest. But suddenly Tesla sparking interest in his son, and he's somewhat concerned. The last time his son had expressed some interest to him was right before Bitcoin had peaked. As well, so he's drawing some parallels. He also goes on in the article to talk about something going on in the bond market that he says is a source of concern of his, and that is some of the behavior taking place in the junk bond market. And what he's specifically referring to is the return of particularly speculative paper called payment-in-kind notes. These are called PIK securities. And during the crazy days of the mortgage bubble that led up to the financial crisis, for example, home buyers would take on interest-only mortgages to get into houses they couldn't afford. With payment-in-kind securities, also known as PIK securities, corporate issuers don't have to pay any interest. They just issue more paper, effectively going deeper into debt. And last week, a company called Husky, which is a holding company for Husky Injection Moldings, a machinery supplier backed by private equity sponsors, announced that they plan to issue $450 million in 5-year payment-in-kind notes. These securities are rated CCC by S&P and Moody's. The yield being talked about is 12%, which is significantly higher than the 5% or so that you're seeing in average high yield or junk bonds. But in this case, the proceeds from this financing will pay a dividend to the private equity backers of Husky, which they purchased for $3.9 billion 2 years ago. What the author points out is that what's taken place here, in his opinion, is we see buyers of this new payment in kind notes getting bond-like returns for private equity-like risks. Also of concern in this transaction, which is highly leveraged, is that the bonds are not even issued based on the collateral of the operating company itself, but are issued and backed by a holding company. Sticking with that Tesla theme, Barrons wrote a separate article talking about Tesla's stock price. It can't be justified, so stop trying. And now they're really careful about saying that this is not a call to short the stock or to suggest buying puts or writing naked calls or something crazy like that, because betting against the stock, they do point out, has been a folly for the last several years. But nevertheless, going into interesting analysis on the stock price, they point out that not that long ago, Elon Musk, the founder and CEO, wanted to take Tesla private for $420 a share, and you may remember the blowback that was received was significant. The deal never got past the tweet stage, but in setting a go private price there at $420 a share just a couple of months ago, Elon Musk, whose ambitions certainly aren't conservative, put a value of $76 billion on the company. Yet, after doubling in price in less than 2 months, Tesla, and this is before the run-up this morning, had a market cap of $135 billion versus that $76 billion that was laughed at just several months ago. And what has changed since that tweet when Mr. Musk talked about taking the company private for $420 a share? Well, not that much. Tesla's still talking about making about 500,000 cars per year. At the time, the estimate for Tesla's earnings per share was about $10.89 per share, and that was the estimate for 2020. Now the estimate for 2020 is $8.49 per share. And just putting some metrics on the Tesla valuation at its current market cap, Tesla is valued at about $367,000 for each 2019 delivery. General Motors is valued at about $6,400 per car. And just to give you some perspective, some may say, well, how about a car company like BMW, which has real ambitions in the electric vehicle market, obviously well respected in terms of performance vehicles. Well, BMW is valued at about $17,000 per car. So that's $367,000 for Tesla, $17,000 for BMW, and $6,400 per car for General Motors. And sticking with General Motors, Barrons mentioned it favorably, saying that the GM is more like Tesla than you may realize. And they talk about the fact that the author of this article perhaps has lost his mind, but he does offer several points to elucidate or to talk about why he feels that is not the case. First, the financial bit. Investors give General Motors little credit for the huge amount of cash that they generate. And conventional wisdom holds that GM's cash flow will be volatile, dramatically dropping when car sales fall, but over the last 10 years, cash flow has actually been very stable, average of about $5.5 billion a year. For 2020, the estimated cash flow that General Motors will generate is about $7 billion, free cash flow yield of about 14%. Currently, General Motors, if you're looking at earnings, trades at around 5.5 times earnings. And they say that that is because the market is treating General Motors like a troubled traditional car maker. The author here is suggesting that General Motors is more tech-forward than you may realize, that they have the Cruise division, which isn't even factored into the valuations we just discussed, and that was recently valued at $19 billion based on investments from other car companies. Sticking with that Cruise story, last week General Motors announced at their investor day that they are close to having an autonomous taxi fleet set up in San Francisco. Tesla certainly makes more battery-powered cars than anyone else, but General Motors is investing heavily in electric vehicles. They just had a teaser spot during the Super Bowl where they talked about their all-electric Hummer. So time will tell, of course, if General Motors can effectively compete in the brave new world of electric vehicles. Right now, the financial markets are saying that they have their doubts, and time will, of course, answer that question. Moving on to a sector that has certainly been unloved, perhaps the most unloved sector of the market, that is energy stocks. Barrons ran an article saying that energy stocks may have hit bottom, and it's time for investors to get in. They say that oil prices, as measured by West Texas Intermediate, have slid 16% in 2020 to $51 a barrel. Natural gas prices are at rock bottom levels, and this is in the middle of the strong winter heating season, but nevertheless they're down 26% over the last year. There are signs from investors that they've been capitulating in the energy space. Weighting of energy stocks in the S&P 500 is down to a record low 3.8%, and the entire sector's value is less than the market cap of Apple, which is $1.4 trillion. The energy space has trailed the S&P for 7 of the past 8 years, and so far this year, the S&P is up 3%. Energy stocks down 10%, so we've got 13% underperformance. What stocks do they suggest taking a look at? They suggest taking a look at Royal Dutch Shell, which yields 7.2%, BP, British Petroleum, yielding 6.8%, and Chevron Texaco, yielding 4.7%. In the ETF space, XLE, which yields 4.4%. Now, one company that they had a separate article on where they were somewhat cautious is ExxonMobil, symbol XOM, which does yield 5.7%. But what they suggest with ExxonMobil is that the dividend yield there is something that could be in jeopardy if ExxonMobil doesn't invest their funds wisely. ExxonMobil, different than many of their peers, is spending aggressively on capital projects that they hope will throw off a lot more cash in years to come. This is a more aggressive strategy, so depending on your belief in ExxonMobil's ability to invest intelligently would dictate whether or not you thought ExxonMobil was the appropriate energy stock to own. Speaking about another out-of-favor sector, Kraft Heinz, the company that was created by Berkshire Hathaway and a Brazilian investment firm 3G in 2015. At the time, it looked like a perfect match. It hasn't worked out that way. The stock's down 60%. Barron's suggesting that now may be the time to consider that stock. They say it's trading around 11.5 times earnings. They say a dividend cut is more than likely coming. But what they do is they compare Kraft Heinz to General Electric, where you've got a new CEO, and this new CEO is likely to sell some assets like GE did, pay down debt, cut the dividend to preserve cash. In the case of GE, investors cheered. The stock went up 50%. They're not looking for a 50% move here, but with a company that's still likely to pay a handsome dividend and with meaningful assets that can assist in a turnaround, they feel the risk-reward has gotten a lot more attractive in KHC Kraft Heinz. Finally, going to turn things over to Brad in 1 minute. Just want to mention in the Bloomberg Muni Brief, the big article on Puerto Rico striking a debt deal. Important to note that this deal still does not have the blessing of the governor, Vasquez, because it doesn't ease proposed pension cuts to some retirees and public workers. But as part of the plan, the board agreed to end its legal challenge to cancel $6 billion of debt sold in 2012 and 2014. In return, again, this is not a done deal, but this is the proposal here that many bondholders have agreed to. In return, bondholders agreed to take 65.4 cents on the dollar for the 2014 debt. That's up from 35 cents in the previous offer. And 69.9 cents for 2012 bonds. That's up from 45 cents. In addition, investors would receive new bonds as well as a split of a $3.8 billion cash settlement. So we'll see how this latest proposal winds its way through the the situation in Puerto Rico, both the governor as well as the need for the overseer, Judge Swain, to approve this as well. We've seen with the electric deal that's been in limbo after lawmakers said that they wouldn't support legislation associated with restructuring the power authority. That these negotiations are complex and time will tell. With that, turn it over to Brad, and then Brad's going to turn it over to our partners over at Goldman Sachs. Good morning, Brad.
Morning, everyone. Thanks, Keith. Morning. I hope everyone had a great weekend. Just to follow Keith's comments about Puerto Rico, in my cynical opinion, the winners here, Puerto Rico, they saved a ton of money on interest payments over the last few years. They probably had the money to pay some of these bonds back, and they kept dancing. The other winners in this situation have been the lawyers, who have been going back and forth and absolutely getting rich on these negotiations. The third group of winners, which is more relevant to us as bondholders, are the pensioners. I think that Puerto Rico has made it very clear that the pensioners will have precedent over the bondholders. This is all, as Keith said, still in limbo. I'm not a lawyer. We'll see if it holds up in court. My opinion is that when it comes to human lives, people are going to save human lives and not bondholders. So to take that one step further, I would be very careful of any pension bonds that you are holding, whether it's Puerto Rico, which is stating the obvious, Illinois, New Jersey, or any other states that have issued pension bonds, because at the end of the day, I do think that the humanity will take precedent over the bondholders, no matter what's said in the legality. That being said, I would continue to sell into any strength in Puerto Rico. I think that anyone who experienced the restructuring of the sales tax bonds, even though they got a little more money back, probably realized that it wasn't worth the headache to get 13 different issues and not really the amount that the island said that you would be getting for the bonds. And in my opinion, is that when you have opportunities to continue to move along in Puerto Rico, you may as well save yourself some headaches, hopefully have large gains in equities that you can offset the relatively smaller losses that you have. I'm actually just a headline that just popped up as we're speaking. The Puerto Rico general obligation 8% bonds have traded up from about 70 cents to about 74 cents on the dollar this morning. And I know that the public building authorities and some of the older bonds are even trading higher, up in the mid-high 80s, and an occasional outlier bid in the 90s. So I would look to see if those bids are available if you have the opportunity. In the more general market, municipal supply still is very limited. However, relative to treasuries, they seem to be a good house in a bad neighborhood. The 15 to 20-year range of the municipal curve is still the cheapest, in my opinion. Obviously, you have to take into account that these bonds can go down in price if we see higher interest rates. But what it seems like here is, at the moment, that conversation is nowhere in sight. I think that could change on a dime, obviously, with the political wins. But at the moment, these 15 to 20-year range munis seem to be pretty attractive relative to what else is out there. And I would also not buy less than a 3% coupon. Anyway, that's lots going on in the world, and continue to stay your course. And
thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.